Capital gain is the difference between the selling price and indexed cost of acquisition. We will have to understand what is meant by indexed cost of acquisition. The central government, acting through Central Board of Direct Taxes, the highest body so far as direct taxes are concerned, gives indicates index point every year based on the cost inflation index. 1/4/1981 is taken as the base year, and 100 points are given for this financial year 1980-81, that is 1/4/81. And for each year, index point is given by the central government. For the current financial year, the index point is 939. So if the property had been acquired prior to 1/4/1981, index point is taken at 100, and it is calculated like this. The property had been acquired for 3 lakhs. 3 lakhs into 939 by 100 is taken as the indexed cost of acquisition. The property had been acquired after 1/4/1981, say 99-2000. The index point pertaining to 99-2000 has to be taken, and the property had been acquired say for 2 lakhs. 2 lakhs into 939 divided by the index cost of acquisition pertaining to the financial year 99-2000 is taken, and that is calculated. If there had been any improvements, what is meant is construction of first floor, or construction of additional floors, then construction of say the compound wall, or construction of the major renovation of the house is taken. Suppose some major renovation is done in 2000-2001, then the index point pertaining to that 2000-2001 is taken, and again it is calculated like this. Suppose renovation has been done for 3 lakhs. 3 lakhs into 939 by the indexation point pertaining to 2000-2001 is taken. So that is also added to the index cost which has been calculated earlier. Then any expenditure incurred on transfer of property, for example brokerage given, which is normally charged at 1 or 2%, then legal fees, then if the property had been sold by a non-resident Indian, expenditure incurred by him or her travelling from abroad to India for the purpose of selling this property, then if any advertisement is given, then that advertisement cost. And if any succession certificate has got to be obtained from the court, the expenses incurred on obtaining the certificate, all such expenses can be deducted from the sale. And the difference between the selling price and this index cost of acquisition plus cost of improvement is called the capital gains. Capital gain tax arises the moment the property is put in possession of the purchaser, or in the case of joint development of property, the property is put in possession of the builder. But the second case, when the case of joint development of property, the possession of the property, it does not, the tax does not immediately arise when the property is put in possession of the builder or the developer, and he has got to apply to the various statutory authorities for permission, planning permission, building permission, etc. So only the day when the permission is granted by these statutory authorities, the capital gains tax liability will arise. Suppose a person has got an old property which he has acquired from his father, and he has been approached by a builder for construction of a few flats, say 4 flats, and 2 flats will go to the person that we will call him an assessee. Assessee is a term which has been recognized by the Income Tax Act, and 2 properties will be taken by the builder, and the builder also gives him say around 50 lakhs as the total consideration. And in this case, the capital gains calculation has to be done like this. And there are some favorable decisions given by the various courts like Andhra Pradesh High Court and Delhi High Court in the case of Vida Duggal, which says acquisition of property can be made, even two properties can be acquired, and in the General Classes Act includes plural also. The front runner in this case is a decision given by the Karnataka High Court in the case of KG Rukmani Amma, which is the Karnataka High Court has held that property, more than one property can be acquired. So in this case, the transaction is entered into, say, today, say 15th of August 2013, then and the joint development agreement will be entered into, and that will be drafted by the builder, and it will be approved by the owner assessee. Then the builder will apply for various sanctions, etc. Normally, because the transaction is entered into well in the first portion of the financial year 13-14, even if it takes 3-4 months, the permission would be obtained by him in the month of, say, November or December 2013. So the cap gains liability will arise for the year ending 31/3/2014 itself. And in this case, the property had been acquired by the assessee. See, if we had purchased the property, then the cost of indexation is applicable. Then he can calculate. The joint development agreement will clearly spell out what are the terms and conditions, how the total consideration has got to be, will be arrived at. For example, he is allotted 2 flats of 1,500 rupees. Then 2 flats into 1,500 rupees into, say, 2,500 rupees is the total approximate construction cost. So that will be determined. So to that, the cash consideration of 50 lakhs will be added. And if there is any rental compensation, suppose I give my property to a builder for constructing the house, and he will be giving me an alternate accommodation, say for a period of 18 months, say at 25,000 rupees. So that 18 into 25,000 will also be added. So all the 3 elements, the total estimated cost of construction, cash consideration plus the rental compensation will be the total sale consideration. So this is from this total sale consideration, the property had been acquired, say prior to 1/4/1981. There again you take 100 points. It had been acquired after 1/4/81, pertaining to that particular year. Then the cost of improvement. So from the total sale consideration, this will be subtracted, and that will be the capital gains. Now, because the investment in 2 properties is made, there is no bar, and in this sale consideration, the first element is 2 into 1,500 into 2,500, so that will be subtracted. If there is any difference, that will be treated as the capital gains. And here again, there is a joint development of property, and the property cannot be occupied by the assessee owner without incurring any expenses for furnishing, etc. Usually 5 to 6 lakhs will be the amount which will not be incurred. For example, modular kitchen, then air conditioning in all the rooms, then all electrical fittings, etc. So that 2 into 5 or 6 lakhs can also be added as a cost of acquisition. Only the difference will be subject to capital gains tax. At the outset, it should be stated that no non-resident Indian wants to avoid tax. So only the question of the quality of advice he receives from a chartered accountant or any professional. Any transaction with a non-resident Indian, any payment made to a non-resident Indian, tax has got to be deducted at 30%, unless the non-resident Indian produces a certificate from the income tax officer, international taxation, that he will not be subject to so much of tax. For example, the same example which has been stated earlier, if the transaction is entered into with a non-resident Indian, the payment of 50 lakhs which has got to be paid to a non-resident Indian, a tax withholding, which is called a tax deduction, at 30%. So 30% on 50 lakhs, 15 lakhs has got to be deducted out of the payments to be made, and also the rental compensation which has got to be paid to him. So 18 months at 25,000. that is 4,50,000 will also be subject to tax withholding. So either the builder promoter has to apply to the income tax officer, international taxation, stating that there will not be any tax liability, or the assessee himself, NRI, non-resident Indian assessee himself, has to apply to the income tax authorities for withholding tax at a less rate, or with all these calculations we say there is not going to be any tax liability. He has got to apply with Form 13 with all various documents, etc. But usually the builder will not be interested, he will not like to take any risk. It is only the NRI will have to apply to the income tax authorities with all the documents. If the non-resident Indian had been filing his returns, there is no issue. If he had not been filing his returns, then he has got to file an affidavit saying that his income for the last 5 years has been less than the taxable limit, and he had the property had then he has got to mention in the affidavit how the property was acquired and what is he going to do with the sale proceeds. So all these things have to be stated in the form of an affidavit. Then this has got to accompany form number 13 with documents how the property was acquired, with a copy of the joint development agreement and what he proposes to, etc. Then he has got to apply to the income tax officer, international taxation, and the normal time taken to issue a certificate is 3 to 4 weeks. Whenever a transaction is entered into with a non-resident Indian, he has got to get a direction from the income tax officer, international taxation, and the direction or the certificate will be issued by the income tax officer, international taxation, authorizing the purchaser stroke joint developer with regard to the withholding of tax. So after all these formalities are done, usually the non-resident Indian has got to file his return after the financial year is over. So after filing of the return, it takes about 2 to 3 months for the income tax officer to process his return. Then after the processing of the return, if he decides to repatriate the funds, then he has got to file a form in Form 15CA, which has been recently amended. And that Form 15CA, a copy of the parent document, the copy of the sale deed, then the copy of the income tax return, then the code of the bank to which the funds will be transferred, the date of transfer, etc. will have to be mentioned. So that will be accompanied by Form 15CB signed by a chartered accountant. So this has got to 15CA, once it is filed, then it is a number is automatically generated by NSDL, the authority for such transactions. Then 15CB is issued by the chartered accountant. Then 15CA and 15CB, when these with all the relevant documents are taken to the bank, then it takes hardly 24 hours to 48 hours to transfer the funds abroad. But if the assessee is sure that he has already complied with the tax obligations, the funds can also be transferred before filing of the return, but he has got to ensure that the chartered accountant has got to ensure that all legal formalities have been duly complied with, because it is a responsibility of the chartered accountant to see that all tax obligations have been properly discharged by the non-resident entity. A free booklet entitled A Brief Analysis for Residents and Non-Residents is available from my website. Thank you.